Good morning and thank you to today's webinar. I draw your attention to the disclaimer up front. This presentation provides general information only and does not take account of your individual investment objectives, financial situation or needs. Please visit our website at australianethical.com.au for our financial services guide and product disclosure statements. Thank you so much to all of you who have made the time out of your diaries to join us for our webinar this morning at Australian Ethical. Our first webinar some months back introduced you to ethical investing and the differences between ESG, SRI and ethical approaches. Today, we look to delve deeper into what ethical investing means for constructing an equities portfolio, and in particular how, despite common misconceptions, an ethical portfolio can and does deliver competitive returns with lower risk. In terms of housekeeping, I bring you to the agenda. I'll keep the webinar to around 45 minutes this morning, including 10 minutes for Q&A at the end of the presentation. Please feel free to enter your questions along the course of the presentation in the window on the right-hand side of your screen. I will cover a brief introduction to our ethical approach to investing. This is really important because our ethical approach underpins everything we do, and it provides a context to the investment process that our equities team will run through after that. I'll then hand over to our highly capable and regarded equities team to walk you through our investment capability and a case study on stock selection, in particular in one of our favourite areas, which is healthcare. Australian Ethical has been leading ethical investing for over 30 years. We were founded in 1986 and we've been operating as a financial services firm with a difference since then. Our core belief is that you can deliver value to shareholders, competitive returns for investors, and impact for society and the environment at the same time. Ultimately, the investment decisions we make and the returns we generate cannot and shouldn't be at the cost of future generations or the planet. I bring you to our ethical charter. The way we ensure we manage our investments and impact is through the lens of this proprietary ethical charter, a set of 23 guiding principles that first look to make a positive impact and then second look to avoid harm through our investment decisions. We use these principles to develop frameworks for how we consider sectors such as fossil fuels and issues such as human rights and animal welfare. Let's see how this works in practice. When we think about ethical, you probably think about what gets excluded in the most part. However, the starting point for us as the deepest green ethical investor in the marketplace is actually the positives. Every stock must have a positive outcome for people, planet, or animals. As a result, we actively seek out beneficial sectors that are supporting what we would consider to be a more sustainable future, such as renewable energy, waste management, IT, healthcare, and education, to name a few. We then look to balance those positives with the potential harm that sectors and stocks may cause. We look to avoid certain sectors and stocks that cause unnecessary harm through the production or manufacture of products and services. These exclusions are a really important part of the ethical process if your clients are concerned with funding things like tobacco, armaments, or oil or coal companies. But our charter goes far deeper than any ESG or SRI investor in the market. We consider broader issues like carbon emissions, exploitation, human rights, and animal welfare. As I mentioned up front, the ethical screening process underpins everything we do and is the first critical step in the investment process, as can be seen in this diagram. Through the application of our positive and negative ethical screening processes, we create our investable universe. To put this in perspective, only 30 to 40 of the top 100 listed companies in Australia today actually get through this process of positive and negative screening, given our market's heavy reliance on resources, mining, materials, and transport. This is where the small cap experience and the sector specialisation of our equities team helps to drive the portfolio construction process and investment returns of our flagship Australian equities portfolio, which we're going into today. Before I pass over to the equities team, I'd like to just quickly show you the performance and some of the positive portfolio benefits of that flagship fund. Our retail fund has over 20 years outperformance track record. Our wholesale fund has been around a little less than 10 years and has outperformed its benchmark and also the broader index of the ASX 200 over 5 and 7 years. Over 1 and 3 years, the wholesale fund has outperformed its benchmark, but is slightly under the ASX 200. This occurs cyclically when resources or other sectors that are excluded because of our ethical charter outperform in the market. Over the history of the fund, which is well over 20 years, we see short periods of this, and then we see it quickly revert to help maintain that long-term track record. And all of this is done with lower risk. As you can see from this diagram of the risk and return of the Australian Shares Fund over 10 years, we have generated this return with lower risk than any of the major indices and the broader universe of Australian equity portfolios. We're sitting in the top right-hand quadrant over 10 years, and the story for shorter time frames is quite similar. We think this dispels that common misconception that clients have to compromise on returns and have to potentially take on more risk to invest ethically. And we've actually been able to prove that for more than 2 decades. So let's move on to hear from the equities team that have been delivering these results. We are joined today by Andy GRACEY, our portfolio manager for the Australian Share Fund and the Emerging Companies Fund. He has over 20 years experience, 14 with Australian Ethical, and he celebrated 10 years as the PM of our Australian Share Fund just last year. Andy and his team were more recently awarded ESG Manager of the Year by Financial Standard and Responsible Investment Fund Manager of the Year by Money Management, which we're extremely proud of. Mike Murray will follow Andy. He's our Senior Equities Analyst who also has over 20 years experience across a broad number of sectors, and the last 3 years with Australian Ethical, focusing on his specialisation in healthcare and biotech sectors. Without further delay, I'd like to welcome Andy to present on our unique portfolio construction process.
Thanks very much, Leah, and thanks for the opportunity to present today. The first slide I'd like to talk through is how our ethical charter actually shapes our portfolio. In this slide, we compare the Australian Shares Fund against the S&P ASX 300 as at 30th of June. You can see in terms of the major underweights versus this broad-based index, energy, we don't invest in fossil fuel companies, which make up most of this sector. We're also significantly underweight materials. We have quite a lowly exposure relative to the index here, and our only exposures are, for example, Sims Metal Management and a little bit of lithium exposure, which we recently acquired. In terms of where our ethical charter drives us, it's in forward-looking sectors of healthcare and information technology. In terms of healthcare, we invest in a range of healthcare companies, right from service providers through to pharmaceutical and medical device companies. Information technology is very important to us. We're significantly overweight the ASX 300 index here. And we invest in IT companies that improve efficiency, encourage innovation, and reduce our environmental footprint. The third prominent sector for us is utilities. And this is where we get the majority of our renewable investments, and these are the gen retailers out of New Zealand. So in terms of our investment philosophy and how we think about investing, look, the major point here is we're fundamental investors. We're not momentum investors. Every single company that we invest in has to get through our rigorous ethical charter that Leah talked about. We look for companies that have got sustainable business models that will drive outperformance over time. The segments or the sectors which are very important to us are healthcare and information technology. Now, these are forward-looking sectors. We see significant scope to outperform the under-researched small and microcap segment of the market by utilising our domain expertise. We don't spend time focusing on energy, on minerals. We spend our time in these forward-looking sectors in terms of information technology, healthcare. We believe we can deliver superior financial performance over the long term, and we've got the past track record to demonstrate that. In terms of our investment style, once again, I'd like to make this point, we're fundamental investment analysts. We're not momentum investors. We describe ourselves as GARP, or growth at a reasonable price. Now, what does this really mean? Well, because we've got our ethical charter drives us to these sectors in terms of information technology, healthcare. And these are typically more growth-orientated companies. The fund is classically benchmark unaware because of our extensive screening. We've talked about 30 to 40% screening in terms of, or 30 to 40% of stocks actually getting through in terms of the large cap universe. We become significantly benchmark unaware, and we're overweight growth factors over time. In terms of stock analysis and selection process, we are fundamental investors. In terms of valuation, we look at price to earnings relative to the market. We're strong on balance sheet and cash flows, and we're looking at fundamental valuations. So in summary, in terms of, we see ourselves as having a value type hat in terms of our stock picking, but we're operating in a real growth-orientated investment universe. In terms of the themes that influence the Australian ethical portfolio, there's a big theme in terms of efficiency, and we meet this theme in terms of our investment into information technology. We particularly like software business models with the recurring revenue nature, and increasingly SaaS, or software as a service businesses. We like internet businesses. We position the portfolio for emergence of EdTech, and we've got 2 or 3 education names in the software space in the portfolio. Now, renewables, we see renewables as playing an increasing role in energy supply, and renewables are now the cheapest form of energy. In terms of the ageing thematic, and this is something Mike's going to talk more about, Mike Murray, our investments in healthcare, there's the service providers, medical device companies, pharmaceutical drug developers. These are interesting to us because they benefit from the ageing population, which we're experiencing in all the developed countries around the world. In terms of, we talked about Australian ethical going into smaller and even microcap companies. In this case, particularly, we'd like to see alignment with management in terms of, we like to see management holding a significant amount of their personal wealth in the company. So our investment and the manager is aligned. We're also overweight defensive sectors. We've talked about utilities. We've got a significant overweight in that sector. So healthcare names are classical defensive names. And we're underweight cyclical type investments. These are the energy sectors, and also the material sector. And this kind of gives the portfolio resilience, which we saw in 2008. And we saw in the second half of 2018, with the markets selling off in terms of being overweight some of these defensive sectors and underweight cyclical sectors. We continue to see opportunities at the micro cap end and small cap end, and this is where we've been able to show we've added value over the long term. Just in summary, positioning versus the market, and this is probably what I want you to take away. Look, we're overweight information technology, forward-looking industry on the basis of efficiency. We're overweight healthcare on the basis of contribution to human happiness and dignity, and we're overweight utilities, particularly renewables. We're underweight big banks. Only 2 of the big 4 banks get through our ethical screening, and we supplement that with some of the regional banks. We're significantly underweight or very light weights in mining, energy, and mining services on environmental concerns. And we're very interested in the emerging healthcare and information technology sectors, as well as education. Diving deeper into the portfolios and breaking the portfolio down by exposures, you can see on the left there our top 100 ASX. Top 100 companies make up around 32% of the Australian Shares Fund, and this is at 31 March. Whereas the classical small companies, in terms of these are ASX 100 to 300 names, make up another 19%. So you can see around 50% of the fund, or slightly more, is invested in ASX 300 names. Where we differentiate ourselves is increasingly in microcap names, and you can see ex-ASX 300, we've got a significant exposure there. In terms of New Zealand, that's a significant exposure, and this is largely the energy generators, renewable energy generators and retailers, in terms of the Contact Energy, Meridian Energy and Mercury Energy. We've got a small amount of unlisted, and that's probably going to stay small in terms of going forward. And at that date, we had a 8% exposure to cash. Now, in terms of thinking about how we invest, we've given you another look of that portfolios at the same date, but breaking it down slightly different. We've broken it down in terms of our global growth names like Fisher & Paykel Healthcare, which Mike's going to talk about, and our software names. That makes up around a quarter of the fund, whereas the biggest chunk of the fund is actually directly exposed to yield names in terms of whether it be the utilities, some of the banking sector, or the REITs. They're an important part of the fund, and they themselves give the fund some resilience in terms of any kind of market downturn. Cash, 8%, as we discussed, and domestic value. These are examples when we find strong kind of valuation arguments in terms of holding stocks, and we put that in that bucket there. In terms of now deep diving really into these holdings, I'm just trying to give you a flavour in terms of some of our investments. Fisher & Paykel Healthcare we've held this for greater than 10 years. Fantastic New Zealand company, large cap really in terms of capitalisation. You can see in terms of the growth names, there's a number of software business models which we like in terms of because they're recurring revenue streams. You can see a number of medical companies there as well. In terms of domestic value, one of our largest holdings is Macquarie Telecom, 3.8% of the fund. This is, again, we've held this for greater than 10 years. It's a data center operator, data center owner, and also a corporate telco company. So it's been a fantastic performer, and we're really pleased with it. In terms of Healius is another name, and Mike's going to talk more about that name. And in terms of the yield bucket, you can see a number of names that you probably well recognise. We hold 2 of the big 4 banks, and there's a number of regionals as well as some of these utility names. So look, in terms of what I'd like to do now is hand it over to Mike, and he's going to deep dive even further and talk about some of our healthcare names. Thank you.
Thanks very much, Andy. I'm just going to give you a brief overview of our stock selection and fundamental investment analysis process before going deeper into the healthcare sector as an example. You've heard some really good material from Andy about why our portfolio looks different to other portfolios and looks quite different to the benchmark. That's not something we set out deliberately to do from the top down. Rather, it involves from a very rigorous fundamental investment analysis process, and that's really designed to maximise the chances of giving our investors the best possible return within our investment universe. And so there's 3 core pillars to that. The first is that we're fundamental bottom-up investors. And you can see some of the things we look at in the left-hand column, but everything really comes back to fundamental bottom-up opportunity. And we try not to pay too much attention to macro noise or to momentum or to the index when we think about our stocks. The second point is that we think in order to get the best returns for our investors, we've got to be domain experts. And so we've got a very experienced team that have been covering their individual sectors for a very long time. And we think to the extent that we can understand those businesses better than our competitors, that's going to give us the best possible opportunity set. And finally, once we know our companies very well, it's extremely important that we value them sensibly. And so we're valuation-oriented investors. We go through a detailed bottom-up financial modelling process for each company. And really what this is about is making sure we're optimising risk-return outcomes for our investors. So we don't want to be, falling out of love with stocks at the bottom or falling in love with them at the top. And bringing all those 3 things together, I think, is what gives us the best chance of delivering competitive and repeatable performance for our investors. To give you an example of how we go about the healthcare sector, it's a sector where we've got a lot of knowledge that resides in the team over decades. It's a pretty meaningful part of our portfolio, on average about 15 to 20%, so bigger than what you'd find in a lot of other portfolios. It's very well aligned to our charter. And as we all know, there's a lot of positive social externalities that derive from the healthcare sector. Importantly, from an investor's point of view, there's also quite a few economic tailwinds when investing in health. Health tends to grow above GDP as a sector of the economy, and there's a number of reasons for that. Andy mentioned ageing. As the population ages, it spends more on health. Other interesting things are that as GDP rises in economies, they tend to preference healthcare spending over other consumer goods. And finally, as technology develops in economies, the cost of healthcare tends to inflate because we get better and better at solving diseases, but those diseases cost money to solve. And so there's more and more opportunities for companies playing in this space. There really is a lot of different companies in the healthcare sector, and that's a really exciting place to be as an investor, because it means when, even if a company that you really like is not showing attractive valuation metrics, you generally can find something that's interesting for a different reason. And we will go right across the healthcare sector in a very broad sense, from the very smallest companies to the very largest blue chip names that you would have heard of. The one risk that we've come to identify that is the most material in the sector through time is government. And this is one sector where you can really see government make or break industries. And you can only think of what's happening in the aged care sector as a good example, and the government inquiries that are going on into that sector and the impact that's having on economics at the moment. I'll give you just a bit of an overview of where health sits in the overall portfolio. So you can see it's a meaningful part, but by no means it doesn't dominate the portfolio. And even within that, we can split it up into either services, devices, or earlier stage companies where we have a small exposure in a very sort of tight risk-controlled fashion. And then looking at what all these companies do, an amazing sort of array of activity, right through to pharmacy, insurance, radiology, medical devices, different sorts of technology in eye health, and very early stage indications in immunotherapy and eye disease and so forth. So we investors right across the healthcare economy, but importantly, we think we're experts, and so we're trying to find the best possible value maximising opportunities at any point in time within that opportunity set. I'll try to give you a few different examples because to sort of show you that not all their companies look the same. Fisher & Paykel is a really exciting company. It's been listed in the health. Actually, you probably heard of it. It used to be an appliance company, or it still is an appliance company or appliance brand, but that's no longer anything to do with Fisher & Paykel Healthcare. The company reorganised itself and spun out its healthcare division in, I think it was 2001. We've been invested in the company for around 10 years. And it's a great example of a company that's managed to reinvent itself several times and take a core piece of technology into more and more areas. In this case, for Fisher & Paykel, it was the insight that humidifying air in situations where you're assisting patients in intensive care with their breathing actually helps with the outcomes that those patients are getting. So what we're mainly talking about there is, when a patient has invasive ventilation in an emergency situation. But they've managed to take that technology into areas such as sleep apnea, into some surgical operations, and into non-invasive ventilation applications. And they've got more and more involved into all the different appliances that build off the back of that technology, such as ventilation masks and controller systems and so forth, which are very high margin products, and they have a nice recurring consumable revenue stream. The one that we're most excited about at the moment is it's moved into oxygen therapy. And so for people who don't know what that is, that's when patients receive assistance with an enriched amount of oxygen, which they hook you up to if you've gone into shock or something like that. And Fisher & Paykel have got a new mechanism of delivery, which is at a higher rate of pressure and humidified. And again, they're seeing better patient outcomes. And so that's a very high growth part of the business. Robust balance sheet. The valuation has doesn't look so bad relative to their peers. It's certainly done very well, and all the companies in the high end or the sort of the blue chip medical device space have done extremely well. But we still think this one is somewhat reasonably valued. The graph there shows, the blue line shows that we've slightly adjusted our position size downwards as the stock has done well, but we continue to remain invested. Slightly different sort of example, Healius, or was formerly known as Primary Healthcare. I think many people would have been to a primary healthcare centre. It's a company we've covered for a long time. We haven't owned it for a long time. It's been working its way through a whole range of problems. relating to declining growth in their medical centre business. Also at the management level, it's been somewhat of a turnaround, and it's also had a high level of debt. So there were a few characteristics that made us think it wasn't such an attractive place to invest. When you cover a company for a long time, I guess you're always on the lookout for things that might change and might put it back onto your radar. And in this case, a number of those things have played out. So we saw the share price weakness, which sort of put it onto the valuation map. And then we kind of sat back and we thought, oh, hang on, actually the regulatory environments for some of these pathology and diagnostic businesses improved quite a lot in the last 3 years. And so here we've got a defensive business. And the final piece of, I guess, the puzzle was the company went into recapitalisation and improved its debt situation and changed its management team. So the company actually changed itself quite dramatically over the past few years, but the share price hasn't really moved. And so we've sensed an opportunity there. These are very strategic assets. They've got the second biggest pathology business in Australia, and they've actually got the largest footprint of medical centres in Australia. And I think what we're actually starting to see now is there are a number of strategic players here and overseas that become interested in those assets. And so there's speculation that this company might change hands at some point, which further helps to underpin the valuation. So that's something we put money into recently, and we think it's an attractive opportunity. Another diagnostic imaging play is much smaller. This was more of an opportunistic investment. It was a company going through quite a lot of problems. Often you find companies that buy a lot of other companies, and this was one of those, run into problems when they grow too quickly and have trouble integrating those acquisitions or take on too much debt. The company approached a number of investors with the opportunity to recapitalise their balance sheet, and with what we thought was a pretty good plan to take costs out of the business and pay the debt down. That strategy played out pretty well, and then it actually got even better when the company managed to sell its New South Wales business for a much higher price than what anyone anticipated. So that's a stock we've actually been comfortable to put even more money. We took some chips off the table and put some more money back into it as we become more comfortable again with the investment thesis there. And it's another company where people are often talking about the potential for corporate activity, because imaging is an industry which is consolidating around Australia. And finally, I'd just like to leave you with an example of a company that's a smaller emerging tech play, but how we think about the risk and rewards in this part of the market. It's worth pointing out that it's a pretty small position for us in the overall portfolio, so it's not something you bet the farm on. But it's quite a unique opportunity, Cyclopharm, because it actually has revenue and it actually pays a dividend, which is a little bit unique in the sector. In terms of what it actually does, it has a lung imaging technology for patients unable to have CT scans. And practically what that means is that when people are diagnosed or with a pulmonary embolism, which is a blood clot of the lungs, the main way that happens is via a CT scan. But there's a portion of the population that are unable to have a CT scan, because CT scans also come with a fair degree of radiation, so they need another technology. This company, Cyclopharm, has developed a gas that's inhaled in the process called ventilation perfusion. And it's a company that's actually commercialised this technology already. It's been developed, it's distributed in 55 countries around the world, and it's been written up in guidelines and journals as a superior technology in that space. It's got a really interesting model. It sells the device that makes the gas or heats the gas, but it also sells the consumable that goes with the process. So it's got a nice recurring revenue stream at a high gross margin. The real opportunity here is that the one country in the world, or the most important country in the world where this technology hasn't been approved, is the US market. It's had a bit of a few trials and tribulations trying to get into the US market, but it's currently going through a clinical trial process, and we're quite excited about the opportunity that represents. And we think when we look at clinical trials, what we really like to see is a company that has already passed a clinical trial process or has a product approved in other parts of the world, because that means that process is slightly de-risked. Now, the market cap of this company is around $100 million. We can find lots of examples of companies in early stage health or any part of the healthcare sector that are trading on very high multiples. Whilst the company's still going through a development phase, so we wouldn't put it on a PE multiple, we think that valuation is quite reasonable for where that company sits and the opportunity that lies ahead of it. So there's some examples of how we think about healthcare investing. I'm going to hand over back to Leah now, I think, for some questions and answers.
Thanks so much, both to Mike and Andy, for their insights today, and hopefully everyone found that of value. We're just watching the screen to see if there's any questions from anyone. If you haven't taken the opportunity to enter any questions throughout the presentation, please feel free now. We have the next 5 or 10 minutes to be able to open to Q&A for Andy and Mike both to address any questions that do come through. While we wait for any to come through on that line, I might just open with a question. We've seen a lot of debate in the marketplace in the last little while, Andy, and we've certainly seen active outperforming. What do you think about the debate of active versus passive, given the underperformance of some active managers or a struggle with some active managers to add value of recent?
Yeah, it's a great question. In terms of passive, there's a lot more money going into passive funds and benchmark aware type fund managers over the last few years. It's a big big amount of money in terms of and there's been a lot of momentum in the market pushing up some of those larger small caps into valuations that we actually haven't really seen before. So we think in terms of this is, while active managers while we have outperformed, it has been a tough market for active fund managers. We think in terms of going forward, and particularly during market sell-offs, this momentum type trade will get punished. And so we can see opportunity to outperform by sticking to our knitting, sticking to fundamental investing, and keeping that discipline.
I'd just throw in there that, our portfolio, you'd be able to see from the presentation, looks very different to the index. And that's on the basis of our bottom-up work and unique insights. And we think that really positions us well. So we're nothing like a passive product. There are products out there that are more similar to the index, and we think probably they're going to have a hard time, but we're happy to be different.
Thanks. Mike, I might put you on the spot. I'm assuming this is in your sector. We've had a question from one of the participants to say, we're not sure whether you discussed, because you came a little bit late, discussed PolyNovo or not. If not, do you have any views about PNV?
Yeah, look, sorry, not really. It's not a company that that I've actively followed. It's done incredibly well, and I think there's a number of other companies that have done well in the sort of emerging and smaller cap healthcare universe, and we're probably reluctant to chase ones that have really run hard. So I guess we're always on the we think as a company that's done really well, but it's not something that we're chasing right now. But I can't really offer you an in-depth appraisal of that.
Great, thanks so much for that. There's a couple of questions that have come in on the controversial area of the big banks, including Westpac and NAB, which we always seem to get. Absolutely. And we may come back to a couple of you on the ethics side of that. We have some in-depth information from our previous webinar, but also that we do produce around our position on banks in general and their role in society from a positive perspective. But one interesting thing that you may like to speak to, Andy, is what more do we see in NAB and Westpac's ethics aside? Is this a yield capturing exercise, or is there something else? Can you talk to it from a valuation perspective?
Yeah, in terms of the banks have actually, since the outcome of the Royal Commission, have actually performed pretty strongly. Just in terms of, we look at our big banks and our regional banks for yield, fully franked yield for investors. Both banks get through our ethical charter, and we consequently, use those for yield. So it's a buy and hold, and we get the fully franked dividends, which are passed on to investors. So that's pretty much our thinking around the big banks, and this type of environment with 10-year bond rates down towards 1%. The 5 or 6% fully franked yield that the banks offer is relatively quite attractive, and probably explains their performance. Anything with a significant yield on it is getting bid up in the market at the moment.
Thanks so much, Andy. We have a question around competitive profile and our comparison of our portfolio, in particular the Aussie equities versus maybe another SRI option. And we will come back and speak to you independently on that. But just to say that, yeah, we do quite often parallel the top 10 stocks, even if you look at the carve out of our Aussie equity portfolio versus an ESG manager or even an established SRI manager in the marketplace, they do look quite different. We do screen to a much larger extent, and we can give you full transparency around how we screen, and then also obviously the approach from a fundamental valuation perspective on some of that portfolio. So we'll respond to that independently. While we're waiting for any further questions to come through, I know that you obviously spoke a lot to the sector specialisation and the small cap specialisation of the team. I think for the audience, you know, when you hear, and we talk about it internally, when you hear 60, percent of the, 60 to 70% or 30 to 40 stocks only remaining in the top 100, how do you go and seek out value and obviously return opportunities for the fund? How do you sort of think about that process when you have such a deeply ethical screened portfolio?
Well, in terms of ethical managers like Australian Ethical, spend a lot of time investing in small companies. We see a lot of opportunities outside the ASX 100, and I think that the broader market is spent a lot of time looking at investments outside the ASX 100 that have gone down the spectrum in terms of capitalisation. Look, how we think about it is in terms of, because of our screening, we don't spend a lot of time on energy, on materials, but we do spend a lot of time on this information technology, on healthcare, and these are really forward-looking industries, often industries with strong IP elements and pretty robust business models. So we like to think of, we see lots of opportunities in that space. We become sector specialists, if you like, while we know little about the mining sector, we know a lot about information technology, healthcare, renewables, and they're important spaces to us, and they're also important for the future.
Thanks. There's a question that probably follows on from that. Is obviously we are dealing, or you and your team are dealing more in that small cap space. So how do you differentiate, or how do you draw the line? And this might be one for either Mike or Andy, between speculative versus investment grade companies, particularly when you get down into that area of new technology, IP, an under-researched area of the market.
Yeah, look, that's a really good question. I'll give you maybe an example of how we approach that in healthcare, because it's something we think about a lot. The first part of that, I think, is we manage the overall risk that represents in the portfolio. We'll sort of set a cap on how much exposure we're prepared to have. And you might find that the early stage healthcare investments without revenues might comprise 2 or 3% of the portfolio. But of course, that's only one part of the equation. That's not all that we do. We spend a lot of time, if it was, say, a biotechnology company, having a look at the science. So we want, I guess, a credible scientific platform. We'll spend quite a bit of time getting to know the people. So Andy and I have just come back from New Zealand. We've been at a biotech conference and sort of seeing a lot of the people that we invest with in a different environment and informally. And often these are relationships that might extend over 5 or 10 years. So I guess we spend a lot of time observing people before we make that leap to investment. And then finally, one of the things we're very careful about in that space is companies' ability to fund themselves. And so we're looking for companies with quite well-defined endpoints to any sort of experimental work that they're doing. We want to know how they're going to fund themselves through that journey. Typically we'd like not to be the only people in town funding that company, so that they're not totally reliant on us. When all those things come together and we actually think there's a genuine sort of significant market opportunity for a company, we are prepared to invest in some of those earlier stage situations. But there's a hell of a lot of due diligence that goes behind it for the very reason that your question implies.
So just chiming in there, we have 60 to 70 stocks in the Australian Shares Fund. So it's a very well diversified fund. And Mike was talking about 2 or 3%. That's in total in terms of the earlier stage companies. So an individual position in terms of a more speculative investment, may be 0.3 or 0.5%. These are large risk returns, and they are a space we're very familiar with. And we've shown over a long period of time, actually, the value that we've added to the portfolio hasn't been in our large caps, it's actually been in our small caps, and particularly on the microcap side.
Perfect, thanks so much. We're almost out of time, so I'm going to probably pose one really quick last question, Andy, whether you can talk to it or not. There's a question that's come through around Infigen Energy. Now that they've added gas to their energy mix, what's our view? I think that's probably going to go across both our ethics and probably our investment decision making, but particularly from an ethical point of view, I would point to the fact that we have very clear thresholds around oil, coal and gas. And we do have some companies, Contact Energy being probably the one that we reference quite often, that does have some exposure up to 20% to non-renewable sources, and we do allow that with the transition to renewable. And so we do have very defined thresholds in place for those particular companies, and then also, or stocks, and then also the companies that we're actually deliberating over in terms of their revenue and distribution mix and things like that. But can you talk to that at all, Andy, around Infigen Energy, now that they have added gas to the energy mix? What's our view?
Yeah, no, I can. Infigen recently added a gas peaking plant in Sydney. This gas peaking plant actually enables Infigen to firm up more renewables. We've got a situation at the moment during the day, and it's been highlighted recently in the press, that the energy prices, when solar is going flat stick, have been zero in all states in Australia. So what Infigen is doing is, rather than just selling their renewable energy into the grid, they're approaching corporates and they're looking to firm up their energy via renewables and a little bit of gas peaking. So through the acquisition of a small gas peaking plant in Sydney, they're actually able to firm up more renewables than they would had they just been selling renewables into the grid. So it's actually a positive for renewables. Infigen won't have the amount of gas peaking that Contact Energy does. We suspect that it'll be around 5% of its total energy will come from gas peaking. And we think Infigen will be actually able to contract more renewables, third-party renewables. So Infigen, if you like, but actually contracts third parties to supply their wind or solar, and they combine it with some gas peaking, and hopefully we'll see significant growth in the renewables portfolio managed by Infigen.
Thanks so much, Andy. We are up for time, and we did say that we would try and keep the webinar to time this morning. Thank you so much for taking some time out of your busy schedules. And I would like to personally thank Andy GRACEY and Mike Murray for their time today. Please continue to send any questions through. We're happy to answer those one-on-one. And obviously, please reach out to Quinn Dam, our Business Development Manager, whose details should be on the invite, if not our follow-up afterwards. And we thank you again for joining us this morning.
Thank you.
Thank you.